Good afternoon, board members. My name is Kat, and I'm here today as Oracle's EVP of Corporate Strategy alongside our two VPs of M&A, Mike and Danny, to present why acquiring Sun Microsystems is not just strategic, it's transformational. Let's start with the fit. Sun Microsystems offers a rare combination of world-class software and enterprise-grade hardware. Java, which powers millions of enterprise applications, will become a cornerstone in our stack. Owning Java means we don't just support the backbone of enterprise, we control it. Sun's Solaris OS and their storage and server technologies give us the opportunity to offer a complete application-to-disk solution. This aligns perfectly with Oracle's vision: simplify technology for our customers through deep integration. And let's not forget, competitive positioning. This deal puts us ahead of IBM and Microsoft by offering a full stack solution that neither can currently match. We also gain an innovative R&D engine and a treasure trove of intellectual property. This isn't just a tech acquisition, it's a leap in capability, reach, and relevance. From a financial perspective, we've taken a disciplined approach to valuating Sun. We used a range of models starting with market comparables like EV, EBITDA, and PE to benchmark valuation. Then we built a discounted cash flow analysis, incorporating conservative projections for Sun's standalone performance. But what really changes the equation is synergies, both revenue and cost. By integrating Sun's hardware into our ecosystem, we unlock efficiencies in go-to-market, R&D, and operations. These synergies raise the total enterprise value significantly beyond what the public markets currently assign to Sun. We also evaluated terminal value using the income and market approaches, and confirmed that Sun's asset base, including its patents, hardware, IP, and global infrastructure, adds real tangible value. Bottom line is, this is not just a fair deal, it's a value creating one. With the right integration plan, which we're already outlining, this acquisition will be earnings accretive and strategic from day one. With that, I'd like to hand things over to my colleague Mike, who will walk you through our valuation analysis and explain why this is a financially sound investment for Oracle.
All right, thank you, Kat, very much. Now I'll be discussing our market approach from Sun Microsystems in the software landscape. To value Sun Microsystems, we selected a comp group of the top 5 technology companies in the software space, including Intel, and setting them as a maximum. And we decided to focus on price to book, price to the last 12 months of sales here, and enterprise value to last 12 months of sales here as well. And these metrics were chosen for data availability purposes, but ultimately allows us to accurately compare and even space out these companies, as you can see to my left. Our pie charts visually show this comparability with Sun Microsystems highlighted in yellow. It showcases its relative position within each metric and evenly spaced out as well, as much as we could. We believe that having a conservative mindset is important to evaluation, and we decided to assign Sun multiples 5x, 0.6x, and 0.4x to each respective metric. And we believe that based off market positioning, the factors that had the majority of our decision making of these multiples is Sun's expected growth and the significant future potential of MySQL and Java, even if Oracle had acquired them. And so, through a weighted average methodology, we valued Sun Microsystems at around $6.2 billion or $8.35 per share, showcasing Sun's strong potential of their assets to grow the company through sheer popularity and total debt levels. Next, for our income approach, we first had to calculate each company's weighted average cost of capital. And so, as you can see here, we used a credit rating approach to detail the after-tax cost of debt for each company based off of their credit ratings. And so, with our calculations, we came up with 4.53% for Oracle and 7.42% for Sun Microsystems. For cost of equity, our calculations mainly used a risk-free rate of the 10-year Treasury, same with cost of debt as well, as an industry standard. And so that was 2.82%. multiplied by their betas, subtracted by our calculated market risk premium to get 10.45% capital cost equity for Oracle and 13.22% for Sun Microsystems. And so calculating both debt and equity costs, weighing them by their respective capital structures, came up with Oracle's weighted average cost of capital to be 7.84%, which is their return for their make sure this deal can work, and 12.40% for Sun Microsystems weighted average cost of capital. Continuing our income approach, we used a discounted cash flow model to analyze the firm's free cash flow. And so first we projected net working capital changes in direct alignment with growth over the next 5 years. And going down, we did calculations getting us to our annual free cash flow, which ends up getting us our terminal value based off of the weighted average cost of capital of 12.4% like we had calculated before. And then as you can see also on the right side, it's actually intriguing to see how net revenue is definitely growing over the next 5 years. However, its annual free cash flow dips in 2011, but steadily goes back up again in the next 3 years, showing healthy future cash flow generation. And so after this, we discounted those projected annual free cash flows, leading us to a total enterprise value of about $4.8 billion and an equity value of $4.7 billion, or approximately $4.8 per share. That's after we subtracted debt and then added back the excess cash like the case provided. Now, what does this tell us? That based purely on this income approach, we believe the company is somewhat overpriced in income. And as you can see at the tables at the bottom, it clearly shows volatility and fluctuation between the share price based off of weighted average cost of capital and growth rate. Our model used 2%, but 3% definitely yields very volatile share prices between it going overpriced and underpriced. And what does this say about its disparity between our market approach and income approach so far? That based on Sun Microsystems' current technologies, it's very highly rated, highly marketed and valued outside by the market, but valued relatively low internally through a pure income generating lens. And this divergence pretty much shows how Sun would benefit exponentially with a player that truly knows how to scale its intrinsic value and unleash the full potential of its groundbreaking technologies like Java and MySQL.
Thanks so much, Mike. And now for the fun part, we talk about synergies. So we projected Sun's free cash flows to the firm from 2010 through 2014 as seen previously. We also accounted for the full range of expected operational improvements and yes, the inevitable integration headaches. Year one starts with a $45 million operating income loss, which reflects the upfront friction that we usually face in these types of deals. But as we progress, synergies begin to materialize and come in the form of improved margins and operational efficiencies. We also accounted for the $1.1 billion integration cost, which helps keeps us grounded and our projections grounded. We then discounted these synergy-driven FCFFs using Oracle's 12.4% weighted average cost of capital, which reflects our capital structure and the risk of integration. And so the result was a $14.72 stock price per share. This includes synergies, and it's more than double Sun's pre-deal price of $6.69 per share. And so it tells us that we're not just buying existing assets, but we're also buying future efficiency and scale. All right, so of course, no model is ever really complete without asking, what if we're wrong and what are we not seeing? And so to test the stability of our valuation, we ran a sensitivity analysis across a range of WACC and terminal growth rates. As you can see, that $14.72 value per share that was calculated at 12.4% weighted average cost of capital and a conservative 2% terminal growth lands us right near the corner of the heat map. And also the heat map was coded in Python by myself, so don't go looking for it in Excel. I can give it to you after the meeting if you need it. As weighted average cost of capital increases or growth assumptions shift, the implied stock price obviously fluctuates as well. But even under less optimistic conditions, our stock price stays within the $13 to $16 per share range. And so this tells us two things really. One is that our valuation is reasonably conservative. And two, even if integration isn't flawless or market conditions shift given the period that we're in right now and the uncertainties, the deal still holds value. All right, so what should we be willing to pay? Based on our valuation and sensitivity testing, a bid range between $10 and $12 per share is justified. That keeps us ahead of IBM's rumored $9.40 per share offer without breaching the ceiling of what's financially sound. Going above $12 per share starts to rely heavily on synergy capture and flawless execution, which is possible but not guaranteed. The bottom line is that this deal is worth pursuing, but not at any price. A smart cap bid secures Sun, scales up portfolio, and position Oracle for long-term competitive advantage.